Good morning everyone. Welcome to the channel that helps you increase your wealth by giving you new trading ideas every day. In today's stream, we'll look at the main economic news coming out today. We'll go through the analyst upgrades and downgrades from this morning and show you how you can make money from trading them. We'll find out 3 reasons why the stock market could flip in the next 100 days. And finally, you'll get a fully transparent look at all my stock positions. You'll get to see my winning and my losing trades, and how I'm positioning myself for future market moves. First, let's head to the economic news. The Economic Optimism Index is releasing at 10. The IBD TIPP Economic Optimism Index tells us about how everyday Americans feel about the economy. Whether you're long or short the market, this will be a piece of news you won't want to miss. The poll evaluates the 6-month economic outlook, personal financial outlook, and confidence in federal economic policies. A reading above 50 indicates optimism, and below 50 indicates pessimism. We expect a value of 42, indicating some pessimism in the economy. A value higher than this may indicate that the economy is recovering faster than we previously expected, would be a good signal to go long the market. But as you'll find out later, I'm actually net short at the moment and think the economy is going to decline further than most think. Next, let's look at upgrades and downgrades. If you're new here, we are focusing on the category column. We can ignore any that are maintains. We are only interested in upgrades and downgrades, and preferably from big investment banks. I select 2 longs and 2 shorts every day so I can track their performance. I'm using the data to build and test a new trading strategy, which you, the viewers, will get access to at some point. I'll explain now using my blackboard. So let's consider the whole stock market. There are 3 main people holding stocks. We have retail, that's you and me, everyday people who own stocks or want to trade them. We have institutions, and we have pension funds. Pension funds are meant to invest for our future. They usually want to avoid risky stocks. This makes it interesting if we have an upgrade or a downgrade by an investment bank. First, let's start with the upgrades. If investment banks start upgrading a stock and the outlook looks better, we're expected in the short term pension funds may buy the stock to hold for long term. This flow of money in makes us think that the stock's going to increase. Similarly, a decrease in analyst ratings makes us think that pension funds that are currently holding the stock may have to get rid of it in order to mitigate the risks. So we're trying to take advantage of these movements. We do this by going at the beginning of market open and looking for any changes in ratings. And then at the market open, we buy or sell according to it being an upgrade or a downgrade. So let's have a look at the upgrades and downgrades from this morning that have come in before market open. I'll refresh to see if there are any new ones. Here's a downgrade, but we'd ideally want a big investment bank like Morgan Stanley or Bank of America. Here we have a downgrade, SST. Let's have a look at that in TradingView. So there's an earnings release coming up on 10th of November. So we can add a little note saying that we're going to go short at the open and simulate what would happen. So that was a downgrade. 8th of November. And the downgrade was by Bank of America. So at market open, we'll see how the stock reacts. Let's head back to our list of upgrades and downgrades. Here we have another downgrade, AD&T. Let's have a look at that. It's got recent good performance from an earnings release. So it was an earnings surprise. Stock has rallied massively, and now there's been a downgrade. So this is an interesting short. I think it's even more promising than the last one. So let's make a little note. Let's put Deutsche Bank. So again, here we are expecting a short. Let's change that to red. So there are two shorts. Now let's look and see if we can find an upgrade so we can find a long. Oh, I did not put up my trading view to show you that. Here's the AD&T downgrade from Deutsche Bank. See if we can find an upgrade. We want to make sure it is from this morning and not yesterday, the 7th. Here's an upgrade, Solar Edge Technologies. Another upgrade here. Let's try and select the ones from the biggest banks as they will have the most weighting and impact on the market. Here we go. We've got a Goldman Sachs and a Morgan Stanley upgrade. So let's do MTD and SCCO. So recent earnings surprise. That was from Goldman Sachs. And the other one was SCCO from Morgan Stanley. So there's our MTD from Goldman Sachs, and then SCCO from Morgan Stanley. Similarly, earnings, there was an earnings surprise, but revenue was not a positive surprise. So let's add our little note. Upgrade, 8th of November, Morgan Stanley. So, two shorts are SST, ADNT, and our two longs, MTD, SCCO. We have around 25 minutes till market open, and we'll follow those at open. Now let's react to why the stock market might flip in the next 100 days.
Oh man, we have just hit a number that brings us right back to the Great Recession. Oh man, we have just hit a number that brings us right back to the Great Recession. We have now had just as many months of 7% moves in the S&P 500 as we last had during the bottom of the COVID market, March of 2020, and the bottom of the Great Recession in 2009. That could be a pretty good sign that we've experienced a whole lot of pain so far, and maybe a sign that we could be getting closer to a bottom. Hey everyone, Meet Kevin here. The stock market is potential.
So let's go over that. There's this idea that a more volatile market may signal that the market is the most panicked it's going to be. So now would be a good time to buy. So it would signal the end of the bear market. I'm going to explain later why I don't think that's the case, but we'll let him finish his points.
Getting closer to a bottom. Hey everyone, Meet Kevin here. The stock market is potentially about to flip again. And stock capitulation often happens right before.
If you don't know what capitulation is, it's simply the retail traders panic selling. So this is idea, I'll draw it out on the whiteboard for you. If you consider a stock graph, over the long term, because of inflation and other factors, stocks tend to go up. And then when we do have selling, we get to this point where all of the retail traders, that's people like you and me, start to go into a panic as markets start to go down. And then they start to panic more and panic more. And this panic selling is called capitulation. And it tends to drive the market further and further down. And at the same time, this is when institutions realize it's a good time to buy. And there's a value exchange where wealth is flowing from the everyday person back into institution, banks, hedge funds, and then markets tend to rise.
Elections, but if it doesn't happen, we've got three major reasons, in addition to what I just showed you about these stock moves, that could sustain a very real rally. In this video, we're going to talk about those three reasons. We're going to start with a little look into capitulation around elections. Then we're going to talk about these three reasons the stock market could actually be set for a massive rally. And then I'll show you which sectors are overbought and oversold. So first, let's go ahead and take a look at capitulation, which is really extended selling or substantially more selling than buying, especially amongst the retail cohort, right around elections. If you've been a subscriber of this channel since the 2020s, you remember, oh, that sounds terrible, since 2020. I don't want to sound that old, since the 2020s. Oh my gosh, it's like we're in 2030. If you've been a subscriber since 2020, you remember I was buying the dip like crazy, right? To the moon rocket launch in March of 2020. That was great. And I never thought we'd see that kind of pricing again, yet on some stocks, we actually are starting to see March of 2020 pricing again. Just look back a couple years, it's scary. But what we also saw was right before the presidential election, we saw a lot of capitulation, a lot of selling, a lot of pressure in the stock market to sell. Take a look at this chart, which shows you that. Not only do we see that sort of capitulation right around the March 2020 era right here, which is this sharp light blue line here, but we also see that right here, the November 2020 elections. I remember in the 2 weeks right before that, thinking to myself, man, what is with all this selling? You know what it is? It's uncertainty about the potential for contested election. Now, this election, midterm election, where
I wonder whether all the other economic factors going on at the moment will kind of soften the blow of any election fraud or any allegations and cause less of a sell-off.
we're wondering, are we going to get gridlock? Are we going to get more democratic control? Right now, it looks like we're going to gridlock. And what's fascinating is we still have 1 day left to see some form of capitulation moves here. We did have negative moves last week, but we're not quite in any kind of capitulation spike territory. We're still, according to VandaTrack, seeing positive net buying from retail. So, what 3 reasons do we have in terms of why stock market performance could actually outperform going forward rather than continue to underperform and bleed out the way it has been? So let's get into those 3 reasons. Reason number 1, stock market performance after the inversion of the 3-month and 10-year Treasury yield curve. This is frequently deemed the last shoe to drop for the Federal Reserve. That is the last inversion that we tend to see in the bond market, is the 3-month.
I'll quickly explain the idea of an inverted yield curve if you haven't come across it before. So in general, we tend to think of long-term investments as paying us more money. So if you were to lock up money for 20 years, you would expect to get a better annual rate of return than if you have the flexibility of only locking it up for 1 year or say 5 years. So the longer the time frame, the higher the expected yield you'd get. So when we look at government securities, government bonds, you have like a 1 year government bond, 5 year, 10 year, so on. So this is the duration. So government bonds go far out, 20 years. And this would be 0. And then the percentage return you'd get every month is on this side. So you'd expect in a normal market for this to increase. So it looks something like this. However, when the yield curve inverts, we end up with a breakdown of this, and the yield curve may flatten or invert. And what's happening here is that investors are trying to price in future performance. So depending on how certain they are about the future economy, they're shifting their decisions. So right now, our 2 year is higher than the 10 year. So you have more incentive to buy a 2 year government bond than a 10 year government bond. And this historically has signaled that a recession is about to happen. So Kevin here is talking about how the 3 and 5 year, those tend to invert later on, is actually a signal that it may be ending.
10-year treasury yield. And while we had an inversion in the 2s and 10s and some of these other things long ago, the 3s and 10s is the most recent and last shoe to drop. You could see that charted right here, where we actually just went negative within the last week. We're barely positive right now, but we went negative, which is great because after the inversion of the yield curve, we tend to see some stock market performance. Take a look at this chart brought to you also by VandaTrack. Look at this. S&P performance following the 3-month, 10-year inversion, first 100 trading days. So right here, you have the inversion point. And what you'll notice on the right is you have returns following the inversion in 81, 06, 68, 19.
So you can see that most of the outcomes are positive and large, and the few negative outcomes are quite small.
00, 78, 73, 89, and 98. You notice the max downside that we got was 3%. And in 3 out of these 9 scenarios, so in 33% of the occasions, we went negative. In 66% of the occasions, we went positive. But look at the magnitude by which on average we went positive. 1%, 2%, 6%, 18%, 24%. So certainly if we took an average here, we'd be somewhere around an 8 to 10% performance. Or if we took a median number, we'd be right around a 6% performance expectation versus the potential downside median of about a 3% performance expectation.
I wouldn't put too much emphasis on this. There are some other issues going on. We have higher inflation than governments can deal with, more so than usual. We have potential wars going on. We have the recent change that the US dollar is no longer the main currency used to trade oil. We have Russia now trading oil in CNY, the Chinese yen.
So somewhat more bullish. In the first 260 days, so that's the first 100 days after inversion. In the first 260 days, we get a little bit more divergence though, and this really leads.
It makes sense that as you increase the period, so the first graph was 100 days, then the next graph is 260 days. So the longer the time frame, the more those prices can fluctuate. So you end up with this larger spread. Before you had minus 3% was the biggest downwards movement, now it's minus 22%. It's just because the time frames increase.
Detail that we have to dive into here. First, without looking at the detail, we get 4 scenarios here. I'm sorry, there's 5 scenarios that are positive and 4 that are negative. And you can see that there are cases where, and it seems to be less likely, or more likely seems to be going positive here, right? 5 out of 9 scenarios, so more likely.
If you consider the stock market tends to increase on average, a 5 to 4 ratio isn't actually that good. This is just average performance. It's nothing special.
Likely to go positive. But you do have a couple scenarios that in the next 9 months.
If you average out all those percentages, you're going to end up at roughly the average stock market return.
After the inversion.
So this chart, although it looks nice, is maybe telling you less than you think.
You actually had more pain. And that was in 68, right before that great inflation period and leaving the gold standard. And in 2000, that was still where you had 2 years to go in the dot-com bubble. Now, a lot of folks are making comparisons to the dot-com bubble now. However, one of the big differences between now and the dot-com bubble is our stock market today has collapsed 3 times faster than the stock market collapsed during the dot-com bubble, leading some to say that the collapse we saw in the 2000s and how that took 3 years could potentially only take 1 year now.
Stock markets may be reacting quicker due to technological changes. There's more algorithmic trading going on, and this flow of data is faster, and this tends to lower transaction costs and make markets more volatile at these extreme times. So it may not be anything to do with the recession, but more how the digital landscape around changing trading has changed.
Well, folks, the market's been falling since the end of last November, and now we're in November again. 3 times faster, 1 year negative performance. Does it mean we could potentially be at a bottom? It's hopeful, but nothing is certain. So, what is the next indicator that we have? Because we don't just have one indicator the market could be at bottom, we have 3. We're going to talk about that right after I mention StreamYard, one of the most reliable.
This is a sponsorship. I'm going to skip over it. We don't need to hear him shilling products to us. Here we go. This is the second one.
Video creation work where you want to. Go check them out. MattKevin.com/StreamYard. So, reason number 2. Potential peak Fed funds rate actually being higher than where we think it really will go. Now, this is an interesting argument because if you look at the current Fed curve, markets seem to believe that the Fed is going to hike all the way to about 5.25%. And a lot of this comes because of the Wall Street Journal and good old Nikki leaks talking about how we're going to probably see, or we could see, right? They like to use words like may or could. We could see 5.25 or 5.5 as a terminal Fed funds rate. And this has led markets pretty red last week because, we had also pretty hawkish Powell, mostly after somebody suggested that stocks were going up and markets were responding positively, even though they weren't. This is the most stupid suggestion a reporter could have ever made during a Federal Reserve press conference. But anyway, 5.25 is what the market is currently pricing in as sort of a peak Fed funds rate. And this could also end up being flatter, which would be a problem because this here would signal more pain for stocks. And if we get a little bit of a steeper...
As I said before, the higher the Fed fund rate, the greater the incentive is just to park your cash in government bonds rather than to invest in the market.
Sort of return, we'd have some gains.
And that leads to lower stock market returns if there's less investment in the stock market.
It's over here for stocks. Now, 5.25 is currently the estimated peak, but that's not actually what VandaTrack is reporting as their potential peak. They actually assess that the peak Fed funds rate could be 4.76%. That's almost a 0.5% lower than the current peak the market is pricing in. And if the market is pricing in higher than reality, then the market's going to have to adjust to a lower rate. What does that mean? Stock market going up. Why could that potentially happen? Well, 2 potential reasons. Number 1 is the fact that we're seeing actual observed rents decline significantly faster than what the Bureau of Labor Statistics is showing in their CPI report. Remember, we get a CPI report this week. We get that on Thursday at 5:30 a.m. I'll be streaming it live. And while we don't yet expect the BLS to show any kind of peak in shelter inflation, we know it's coming, which is optimistic, and even the Fed knows it's coming. They're just waiting for this inflection to happen. For the CPI this week, I'm actually relatively optimistic. We're expecting 0.6. 0.6 on the month over month, which actually, in my opinion, is great because it's relatively high. Last month, we had a 0.4, and anytime we get a high estimate, it's really easy to come in under it. What's bad is when we have estimates like, oh, it's going to be 0, and then it comes in at like 0.1 on the month over month, right? That's bad. But anyway, let's see what happens with CPI. But this is one of the reasons they give is the inflection point in rents. But the second reason that we should think about, I've gathered this from other sources, but it's also...
If you don't understand, so there are 3 lines here. The red is this figure that the Bureau of Labor Statistics uses for inflation, and it lags considerably. Whereas if we look at more real-time information, even though there is a lag, it's less. So Zillow and Apartment List, their average rents have gotten lower relative to previous months.
Second reason that we should think about, I've gathered this from other sources, but it's also, I think, very valid, is that payroll growth is set to be at 0% by the second quarter of 2023. That's really going to help drive pressure down on the Fed to keep hiking. So maybe VandaTrack will be correct on this. But we also have a third...
So the lower payroll growth means that the Fed is incentivized to try and stimulate the economy by not increasing rates as quickly.
Potential reason to be happy, folks. And then we're going to talk about the oversold and overbought sectors. And folks, it is the potential for a rally post-election. Remember, this red here is post-election. And usually in the about 50 days that are left in the year after an election, about 52 days after the election, we tend to actually see kind of nominal, slightly positive performance. But it's in that next calendar year, starting in January, that we really get some beautiful average long-term returns. Take a look at the chart here. If we get a split House and Senate or any form of gridlock, we're expecting between 1.4 to 2.9% returns on average by the end of the year. And if we look at next year, we're looking at potentially as much as 18.7 to 19% rally mode, baby. So very, very bullish signs here. Where are the overbought and oversold? Here you go, folks. If we compare sectors to the 2-year real rates to screen out what is out of sync with the Federal Reserve's hiking cycle, what do we see? We see sell signals at energy, nickel, the dollar, Italian and Brazilian equities, and silver. Here you go, divergence of anywhere between here 7 to 15%. And where do we see buys? Well, potentially Taiwanese equity, cotton, technology stocks, discretionary, U.S. consumer services, and coffee, baby. Buy.
Coffee has been down for a long time. We can check that out on TradingView. So we've had this large decline in coffee. So I think I would agree with Kevin that this is an interesting trade. We may see long opportunities in coffee.
Signals across the board here, also anywhere between 5-6 to 17%. So if you want to get some of the best data every single day, what do? You hit that subscribe button and come back to this channel multiple times.
We're seeing a lot more YouTubers and media channels promoting this idea that the stock market is about to flip and that everything's going to be okay. And it's interesting how you can change public sentiment of whether stocks are going to rise or not by influencing these media channels. So maybe if all the channels that produce financial content start saying positive things about the stock market, that feeds out and everybody feels more optimistic and invests more. Right now we have less than 3 minutes to market open. Let's have a look at my trading positions as promised. So here's MetaTrader 5. I have one long position in SunPower. It's a solar company. It's been going down in recent times because of legal problems. But the company is solid, the revenue is solid, and once the legal issues are sorted out, I think it will be a good long, especially with all the energy problems we've been having. So let's show this on chart. I have been long for some time, but obviously markets have been declining, so I would like to see this reverse soon. Then as you can see, I am heavily short with the rest of my positions. I have a mix from pharmaceutical companies to banks to retail to a big mix of everything. I've even got Norwegian cruise liners. So at the moment we are in the negative because of the recent rally, but I still expect the stock market to go down in the midterm. As you can see, I've been short for a long time. Here I rebalanced my positions, which is why it's a lot of red. It was at the beginning of the month, as you can see, but the rest of my trades have all been quite in the green, apart from the rebalancing. I closed a few trades recently in the green as shorts. So markets open in 30 seconds. We are expecting markets to open higher than yesterday, but we'll see what happens on the day. If we head back to the trading view, we can watch our upgrades and downgrades to see if they perform as expected. So just as a recap, our downgrades were SST and ADNT, and our upgrades were MTD and SCCO. So we are collecting data and simulating buying them or selling them at the market open, and then we're using that data, and I'm going to build a trading model for us that I'll share with you at some point. So markets are open, and they are going red from the open. We'll see if this carries through the rest of the day. I'm always happy seeing red candles nowadays because they've been short for a while. But as you can see, this was after hours trading and slowly been edging up during after hours. So actually we are similar to market close right now. In fact, a little bit above it. No data on SST. Goldman has gone up, so this was the open. This is the opening candle, so our buying price would be here. Let's make that blue. And for SCCO, we opened very high for the day. So actually our buying price is going to be here. So we'd be taking a loss at this point. A small loss, but a loss still. ADNT, we still have no data. SST, still no data. For my positions, will be even more in the red, I would think. Oh, actually we're recovering a bit. We're seeing a lot of selling action as the market opens. Here are my positions. So this account was started at the end of September with $1,000 US. So we're up around 5% in equity, and it's going well, considering that markets have been a bit all over the place and a lot of people have lost money. I don't believe in being long only. So now is the time where I should be able to outperform others in the market that are purely long focused. Let's watch some more YouTube videos to try and get some new trading ideas.
The economy has slowed significantly from last year's rapid pace.
The level of economic activity is likely to be flat and even fall for some time.
Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions.
People at the lower end of the income spectrum are reporting that they are really having difficulty making ends meet.
For a long time, inflation had been low and stable. Most people did not have to worry about inflation, but that has changed.
The recent inflation data, again, have come in higher than expected.
Consumer price inflation now stands at over 10%. But I know for many people it will feel worse because the prices of essentials like energy and groceries have risen by much more.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate.
We have one of the largest upside risks to inflation in our forecast that we've had in the 25-year history of the MPC.
The longer the current bout of
So this is what happens when you have monetary policy that increases the supply of cash. The whole idea of giving people money during COVID to increase spending just leads to a ton of inflation in the economy and no real growth or positive benefits to society. But at some point, it has to be repaid, and that's in the form of higher inflation.
high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. It will take time, however, for the full effects of monetary restraint to be realized.
If we do not act forcefully now, it will be worse later on.
In the last 2 days, the US Federal Reserve increased rates by 75 basis points to a rate of 4%, the highest rate since January 2008. Bank of England in the UK has also increased rates by 75 basis points, something they have not done for over 30 years. Andrew Bailey, the governor of the Bank of England, has just declared that the UK economy is probably already in a recession, and the official Bank of England projection is that this recession will last until mid-2020.
We've been in a recession for a while.
Which would make it the longest recession in history. The stock market is an absolute freefall, falling 5% in the last week, going up and down every day for no particular reason, down over 22% so far this year. And the world is in full-on panic mode. Bad news is good news for the media, who are publishing non-stop doomsday scenario predictions, and exactly 1 year ago, every financial commentator would tell you that the stock market is about to explode. You have to go and buy in because the stock market had one of the biggest bull runs in history, raking in huge gains for 3 years in a row. And now,
let's cover the psychology of this. When stocks increase, the average person becomes more interested in holding stocks because they've seen the past performance is good. They want in on it. So more and more people will start buying when prices are high. And as prices get higher and higher, even more people jump onto the bandwagon and start buying. So what happens is, near the end of stock market rallies, more and more retail traders and investors, people like me and you, average Americans, invested in the stock market, and institutions will be lowering their exposure and putting more and more money in cash. And then when the stock market crashes, all the retail traders start to panic sell. And then institutions start buying up positions, and then this cycle continues. So if we look at the average investor, they usually get the worst of it. The average investors tend to buy late in the market cycle, and then they panic or they need to sell at the bottom, often leading to losses, which is funny. Well, not funny, but rather sad and tragic. You consider the stock market actually increases over time due to inflation. Yet the average person often loses money during economic cycles. This doesn't really make any sense, does it? So my advice would be to not just blindly buy in to this excitement of buying stocks, especially when news outlets and the media is promoting it. Have a clear defined strategy for investing if that's what you want to do. and buy in slowly. Treat it like adding money to a savings account over time. Buy in slowly, and this is called dollar cost averaging. If you're interested in trading, just what I do, you can make money during the ups and the downs, but it is much higher risk, and you may lose your money. Let's keep watching.
After the stock market has fallen, those same tea leaf fortune tellers are there telling you that everything is of course about to collapse another 50% from here. Michael Berry and Jeremy Grantham, who have perfectly predicted all 69 of the last 3 financial crashes, have once again proven that if you perfectly predict
anybody else hear that?
another 50% from here. Michael Berry and Jeremy Grantham, who have perfectly predicted all 69 of the last 3 financial
All 69 of the last 3 financial crises.
crashes, have once again proven that if you shout wolf long enough, eventually after a few years, one is going to turn up. And a growing number of voices are getting
I think a lot of YouTubers just get bored and add in little Easter eggs to their scripts and no one notices.
swallowed by the panic. You've probably noticed the anchors on CNBC or your favorite finance YouTuber changing their tune 180 degrees. Long-term projections, of course, do not matter at all anymore because the world is now burning, and every long-term investor with a 20-year horizon on their investments has suddenly mastered the art of candlestick wizardry, a mysterious craft that shows financial charts to a black cat at exactly midnight on a full moon and listens to the pitch of the meow that the cat makes to predict exactly which way the stock market is going to go tomorrow. The noise can be deafening, and it can be very easy to start questioning whether you are blind to the obvious impact.
You've got to remember that YouTubers don't have the incentive of teaching you useful skills. They have the incentive usually of selling some affiliated product or some kind of advertising along with their video. So they're just going to speak about whatever gets the most hype at the current point.
Pending doom. I mean, how much clearer can it possibly be? The biggest companies in the world are missing on their earnings. In the last week, Google missed and fell 10%, Amazon missed and fell 10%, Facebook has spent $40 billion on making
This will keep happening if wages don't increase as well.
avatars without legs when they could have bought a Nintendo Wii with superior graphics and avatars that do have legs for $40 on eBay. Stock prices are falling so low you might soon get paid to own stocks. But just before you go and sell out of all of your stocks because a financial expert on YouTube who happens to have no financial background whatsoever told you to sell, take a moment to step out of the never-ending hum of the doom and gloom and take a look at what's actually going on. The US Federal Reserve, Bank of England, and most central banks around the world are all telling you in unison that they absolutely exactly know how far the economy is going to collapse in the next 2 years. They have these armies of analysts, they're producing these reports with charts and numbers, and
They lose their jobs if they tell people they don't know what's going on. That's the sad reality. They need to create a false reality in where they pretend they know everything and they're confident about it. Otherwise, people vote them out.
data and stuff. The worst recession since the 1930s is on the way. The stock market will have the biggest fall in recorded history. You better believe it. But then consider that these same people just 1 year ago were telling you something very different. Just 12 months ago, Jerome Powell told the US Congress that inflation was transitory and was going to disappear all by itself. In December 2021, the Fed projected that the GDP would grow by 4% in 2022. This forecast increased from the 3.8% that the Fed was projecting in September 2021. In that same December 2021 meeting, 16 out of the 18 members of the FOMC agreed that interest rates this year in 2022 would stay under 1%, with the other two thinking maybe they'll just go just above the 1% mark. At the same time, interest rates were at a historically low rate of just above 0% just a few months ago, while inflation in December hit 7%. The gap between the 7% level of inflation and the 0% interest rates was by far the biggest in recorded history. And yet today, this Muppet show that couldn't tell their ass from their elbow yesterday are suddenly being put up on a forecasting pedestal. It's a bit like walking up to a roulette table, watching an idiot place his life savings onto the table and lose it all, and then asking that idiot for advice on where you should place all of your money on the very next spin. It sounds ludicrous, but that is exactly what's happening right now because hysteria has a funny way of absolutely weirdly changing people's perspectives.
We spoke about that in my little diagram. As soon as markets start falling, everyone freaks out and changes their behavior of long-term investing.
Here are some basic facts about the state of the economy today. Natural gas prices have fallen by over a third since their peak during the summer, as the world and Europe in particular were panicking about Russia cutting off supplies. Increases in production in Norway and Netherlands, record-breaking supplies of liquefied natural gas from the United States, a new deal with Azerbaijan, and a mild October have all calmed the markets. Oil price remains relatively high at around $90, but is also substantially lower than the peak back in June. Inflation in the US is at 8.2%, and lower energy prices are masking the fact that overall inflation is still running very hot. Food prices are going up 1% a month, shelter in the CPI index is increasing at 0.7% a month, and probably going to increase further than that. But after the most recent increase, interest rates are now at 4%. The gap between inflation and interest rates is now down to 4.2%, a very substantial decline from a gap of almost 8% in February this year. And in addition to rates going up faster than inflation after 3 consecutive 75 basis point hikes, the Fed is also implementing a quantitative tightening program which has never been done before. And this program should enhance the effect of increasing rates.
We don't quite know how the quantitative tightening is going to go. These programs, whenever something new is introduced, it tends to be far more inefficient than people think. So $1 of funding towards a project tends to only have 20% of the desired effect that $1 should have. So these things are inefficient.
Rate, multiply the effect. US employment remains very strong, which is surprising, but a very good sign despite the situation in the economy and the actions of the Fed. And at the same time, consumer demand in the US is falling sharply, a very unique set of circumstances. We saw AMD post results in the last few days where demand for their expensive computer processors from retail clients specifically fell by over 50% in just 2 months. And this fall in demand means that heat is already being taken out of the economy as people cannot afford to spend money because inflation is putting a lot of pressure on their ability to spend their wages. The Zumper report showed that inflation in rent prices has started falling back in June and dropped a lot more sharply in October, the first such decline in 2 years. The upward pressure on inflation has started to reduce even as CPI is catching up because of the lag effects. At the same time, we're seeing a very interesting effect in the post-COVID stock market performance. During COVID, many companies absolutely blew up, some out of nowhere. People were sat at home, stimmy checks and financial support was being thrown at these people at the same time as they
Most of it went to Amazon.
Were sat at home not spending any money on going out. And many companies from Zoom to Facebook to Peloton saw absolutely ridiculous growth that was not in any way sustainable. Many of these companies saw their share price boom as well and go absolutely bonkers as a result. And now most of those bubbles have burst. Zoom is trading at below the price that it was at before COVID. Amazon is trading at below the price that it was before COVID. Growth stocks like Fiverr are trading at below the price that they were before COVID. And we are seeing earnings scores happening right now, every day, where performance today is being compared to the ridiculous performance a year ago during COVID. So growth of every company has fallen in recent quarters, but many of these companies have seen their revenues grow in the last 3 years. And while the rate of growth now is a bit slower because it is being compared to some bonkers growth before, the P&Ls and balance sheets of many of these companies are in a much better place than they were 3 years ago before COVID arrived. And after the inevitable unwind in the year after COVID that we are witnessing right now, you have to ask yourself the question: The Fed is more than halfway on the way to matching interest rates with inflation. With QT, they might be a lot further along, maybe 70 or 80% of the way there. Corporate profits are about to come out of the COVID lapping effect, and next year's performance will then begin being compared to this year's performance. And numbers suddenly might begin looking a bit different. Despite a squeeze on people's budgets, we have a relatively unusual financial crash during which employment has remained stubbornly resilient. Just this morning, non-farm payroll numbers came in way better than expected at plus 260,000. And this means that if employment remains resilient as a recovery starts, the economy will be in a far better shape to accelerate out of the turn than in any of the recent previous recessions when unemployment rates skyrocketed. Back in February, after
Still early days, and unemployment may increase over time.
Russia invaded Ukraine, Eastern Europe was concerned that Putin would roll his tanks west, taking one country after another. Today, Russia is retreating in Ukraine as the fearsome Russian army appears to be made up of mobilized civilians with zero training and a rusty AK-47. Just as we didn't know about the war in Ukraine a year ago, we do not know what will happen next year. Absolutely no idea what the next year is going to bring. I don't know, you don't know, the Nostradamus financial experts telling you they do know have absolutely no fucking idea. So before you stop being a long-term investor and join the dark side of the gambling degenerates trading candlestick patterns, remember that technical analysis never lies. And
You've got to remember that one of the most successful funds of all time relies on technical analysis.
technical analysis conclusively proves that the S&P 500 is about to boom.
Even if you take the most famous value investor using fundamentals as Warren Buffett, his ideology that value stocks outperform growth stocks over time has not been true since 2008.
100%
So we may
definitely for
have reached an end of the fundamental value style investing. And we may be leaning towards other approaches like AI, ghost markets.
sure, because look, it says so on the chart. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching.
Quite a mixed video. There's no sort of real outcome. It's more just nobody knows and I'm going to make a YouTube video about it to get views. Let's have a look back at TradingView to see how the positions have changed. So we've had a large movement up for SCCO as expected. Our other upgrade has performed amazingly well. It is up 1.7% so far. SCCO is up 0.4% so far. Then let's look at the shorts. SST opened at 412. So we would have gone short here. And it's down 3.6%. So that's as planned. ADNT is down as well. As you can tell, analyst ratings do actually matter. Doesn't matter how ridiculous the analyst ratings are, funds react to them, and that's important to bear in mind. Just because something illogical has happened doesn't mean everyone else won't respond to it as well. If we look at my portfolio, not much has changed. It's going to fluctuate $5 to $10 every day. I don't mind that. The main thing is we want the S&P to fall. And that may take some time, especially with all the midterm election news and a potential boom after that. But long term, I expect this trend to continue downwards until we bottom out somewhere in the 300 area. That's my current estimate. Let's now take the other approach. We've heard two YouTubers talk about investing. How does a billionaire see what's going on? So we're going to listen to a video by Chamath.
The thing that you have to do before you talk about what is happening now, I think it's probably useful to...
There's a bit of background. Chamath worked at Facebook early on and another few social media companies during the whole Silicon Valley boom.
Go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet to buy toxic assets. And the ECB did that, and I think Japan did that as well. Anyways, a bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth.
This isn't a new idea. It's been going on since the beginning of time. Whenever currency isn't backed by something physical like gold or silver, you end up having institutions and countries that can spend an infinite amount of cash, and they will do so because the incentive is to.
And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is, like, we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize...
So Chamath is saying the problem isn't in the last 2 years and the economic system is slowing down. It's been in a false money economy since the last recession of 2008. So this whole period of growth we've had has been with fake money and isn't necessarily real. And there are underlying economic problems that haven't been fixed. We need to pay for them now.
Realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last decade and a half have to get undone. So that's the backdrop. So if you think about taking $30 trillion out of the global economy, you're talking about almost, I think it's 85 trillion is the world GDP. So it's almost half of an entire year's worth of global GDP. It's going to take 3 years probably of the slow, meticulous, running off of money.
It's interesting, the different approach. The YouTubers are like, everything's going to be okay. We're at a stock market bottom. Things are worse. Things aren't as bad as people say. And then the billionaire is like, this is a big problem. There are bigger economic problems at play. And it's going to last a longer time than people think.
Not reintroducing new money. So it seems like we're at the beginning of something that's going to be long and drawn out. And that's separate from whether we're in a recession or not. That's just the bear market that we're in, right? And so you have to look at asset prices today as a microcosm of a much larger trend that has to be about fake money pushing asset prices up, and now taking all that fake money out and finding out what the real price of something is. And I just don't think that takes 6 months. So for all the people that were, fingers crossed, hoping that this would be the end of it, Fed raises 75, we're done with this, they're going to raise 75 more. I just think that's not how it's probably going to be. It's going to take, 24, 36 months. That may mean the bottom doesn't happen for another 18 months. So I think we're in for a lot of choppy market action. We may not be negotiating against Russia, but we're enabling them to print enormous surpluses. Meaning, I don't know if you guys saw, but there was an article today. Janet Yellen is traveling around basically convincing folks to not include Russian oil from a bunch of import bans so that these Russian oil tankers can be insured Why? So that they can sell this oil to places like China and India, etc.
The ruble's at a 5-year high.
We push for all these sanctions. Europe gets on board and says, we're going to do it and we're going to take the lumps. And then we go around Europe and basically say, well, we kind of want to fight this proxy war, but at the same time, we want to try to fix inflation and we didn't mean to cause this. And it's completely disorganized what's happening.
Okay.
Look, here's the thing.
Wars of attrition are based on this, that the side with the most resources ultimately is going to win. And Russia is set up that it is on the side with the most resources. And now that we have a lot of inflation in the West, everybody realizes that.
I think we have to also be sensitive to the fact that the Fed operates on a certain class of data. And that data in the 21st century is pretty pathetic. There was an article, I think it was in the New York Times, that really walked through how CPI is calculated. And it's a bunch of people that work for the government that walk around with iPads, building relationships with local businesses in all these random places all around the country and asking them to, chit chat for 15 minutes and do these surveys. Now, you would have thought that in 2023 or 2022, what the government would have said to Visa, MasterCard, American Express, all the payment rails, the banks, and Stripe is, send me a feed in the following structured way so that I can actually have an absolute precise sense of inflation, because inflation really only occurs when a good or a service trades hands for money, right? And you calculate what did that thing trade at the day before and what does it trade for today? So you could get an absolute precise sense of it. Instead, we do this random sampling thing. If you read this article, your takeaway will be, oh my God, this is very rickety, and it drives an enormous hammer that we use to try to manage the economy. That's the first thing. I think you need to buckle your seatbelt.
So not only is there a time lag, the data itself is inaccurate.
The next 3, 4, 5 months of CPI will probably be very, very bad. 7, 8, 9%. Why?
You'll find that banks and funds have their own ways of predetermining inflation rates, and then they predict what the Fed will do, if that makes any sense. So they will have their own metrics and systems of determining inflation that are actually probably more accurate than what the Fed currently uses for CPI.
There are a handful of components that have gotten completely run away. Number one, the biggest one is rent. And so rent works on a 3-month lag. We're going to reintroduce what the true owner's equivalent rent is into CPI. So we can already forecast that CPI going up. Russia is basically trying to break the back of Europe by now messing with their nat gas supplies. The German energy minister yesterday said that if that happens, it could be a contagion equivalent to Lehman Brothers with respect to energy.
This is likely to play out at the middle to end of winter. So we're right at the beginning of winter now. But come December, January, February, that's when this would play out worst in a negative scenario.
When you play all of these things out, what you have is unfortunately rampant runaway costs that really have no mechanism to get back in check in the absence of some real governmental changes. Our policy on this Ukraine-Russia war, how we intend to sort of work or cooperate or fight with China, all of these things have to get solved. So in the absence of that, prices are going to continue to go up. And so what does the Fed do? How does it throw away what little credibility it has left when there's 8 and 9% inflation prints and saying, we think we're done for right now? You can't do that. So they will overcorrect because there's just going to be so much pressure for them to act.
Everybody's going to be pointing at the finger at the Fed now, saying that they're the ones that messed up. So they're going to have to make dramatic changes.
All roads, I think, lead to lower equity prices. We've seen the first wave, but now it has to touch all these other areas. For example, we have gotten totally drunk on debt as a country. One of the most obvious places where we've been serving alcohol far too late into the night is in the financing of all these private equity leverage buyouts. These are sketchy companies that are sort of like teetering on insolvency at times.
The other very obvious place where debt has been handed out too freely is to students, university students, putting them in a huge amount of debt that they cannot repay.
Where private equity comes in, levers up the balance sheet with debt, they price it right to the edge of what's legally allowed or what's financeable, and then they go do it. But that's all assuming the economy continues to grow. And so if all of a sudden you have some recessionary forces or prices go up and earnings don't, You'll have a contagion in the debt markets. You could have a contagion in the commodity market. So we're dealing with some really tough boundary conditions. I do think that we can know these things without sampling in such a porous way. And now, we're going to look, we've had a system of overcorrecting and undercorrecting for years. The problem is the stakes get higher and higher as the economy grows and becomes more complicated and intertwined
And we have
with
more
other
leverage.
economies. I also want to tell you guys a quick story. One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of economics, inflation, asset prices, equities. Everybody was saying, oh gosh, the market's going to rip on the open. And then on Tuesday, the market, the S&P was up like 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down like 400 points, right? So
Why do you think Facebook was down 400 points? It's already been down a huge amount. Why does it keep falling?
it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called.
There were analyst downgrades, just as a backup. I think he might mention them, but he might not. But there were analyst downgrades at the same time.
Called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail.
So that's people like you and me. Average Americans are the poorest informed people. They have the least financial education.
And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook.
So the spectrum is average everyday person knows nothing, and massive funds with lots of people, lots of data, lots of information, well educated.
Facebook is an example of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up. Now, why?
So the expected earnings of Facebook is actually way lower than all of these funds originally thought, is what your math is saying.
Why is that important? Well, eventually you're going to touch all these other stocks as well that are going to go through earnings revisions in this recession. This is where I think Wall Street has done a very poor job on behalf of retail.
So these firms that we've covered already will issue upgrades and downgrades as they start to look through their stocks and realize that a lot of them have been mispriced. And most of them are going to be downgrades, is what your math is saying.
If you look at the average estimates of earnings, you will be shocked to hear that Wall Street actually has this year being record earnings, next year earnings continuing to go up. How is that even possible? How do you see earnings continuing to go up into these prints like this when you cannot pass through 80, 90% increases in energy and COGS and whatnot? You have to sell fewer things because there'll be fewer people with jobs to buy things. I think Wall Street's wrong. And I think that earnings are going to go down this year and will definitely go down in 23. And so I think what probably happens is the entire world of equities needs.
So you have everyday people thinking we're at the market bottom, billionaires thinking we're going to go a lot further down for a lot longer.
To get repriced at a lower price. And in that, it's going to put enormous pressure on these cash-burning, non-profitable tech companies.
Would you go on the side of the billionaire or the YouTuber?
Part of the government acknowledges that you have to really ring fence and protect consumers. If you look at the securities laws, they're meant to protect them at all costs. But the reason is because sometimes you want people to make good decisions, and if you give them a bunch of firepower, they're just going to spend it. And what we really did was we gave folks just a ton of money. And what did they do? They acted rationally. They spent it. Now we have to take it all back. I don't think that's going to be as easy or as simple as people think. It's stunning that, the reason the stock market went up, dollar for dollar, was actually tied to the growth in the M2 money supply. The correlation was 0.92. So for every dollar that the Fed printed, the stock market went up by 92 cents. So it stands to reason that if the Fed is going to take 3 to 5...
It's not quite how correlation works. He's quoting what covariance would be doing, but it's a minor
$1
point.
trillion of value out, then we have to re-rate the equity markets by $3 to $5 trillion at a minimum. And then you have to re-rate and re-baseline for earnings. And so that's probably another 20 or 30%. You're assuming that all of a sudden like demand is stable, but it's not necessarily stable. In a demand contraction, yes, people get fired, but then also new job openings change. There's fewer of them. They're more specific. Again, we're at the beginning of the beginning. For all of us that lived through 2000, this was 4 years of sheer hell and a grind. Now we have $30 trillion that we have to work through the economy, a recession we have to overcome, a war we need to end, and people all of a sudden assume that 2 or 3 rate hikes and 5 or 6 months of headlines are enough. And on the margin, maybe they're right. But from my perspective, it's an observation that we're at the beginning of something that just fundamentally has to take some amount of time to work its way through the system. And so I don't understand why anybody would give up their liquidity in this moment right now. Why would you? Why would I give up $100 million of cash in my bank account? I would not do that right now.
The people in Russia are suffering during this. The people in the Ukraine are being murdered. I mean, how does it end?
The problem is that Biden engaged the United States in a proxy war without our real explicit discussion, number one. And then number two is then we pulled and we pressured Europe to really draw a hard line, but then now are kind of working around it so that the countries that suffer the most are Europe. Now, I think you're starting to see the tea leaves, though. Last week, there was a group of European leaders, I think it was Macron, Draghi, and one other person, who went to Ukraine. And if I had to bet, I think the message was we need to find an organized detente here, because there is, according to Europe, a Lehman-like situation in terms of economic contagion that could manifest over the next months. So I think
Lehman Brothers was the bank that collapsed in the last recession. That was kind of the trigger for the rest of the financial system collapsing.
I think that the end game is probably some organized, negotiated detente and ceasefire. I don't think anybody will be happy with it, but I think by and large, Russia is and has won, meaning they've won economically. They're selling oil like it's not going out of style. It's just not selling it to Europe and to America. They're selling it to China, they're selling it to Africa, they're selling it to India. We engage in economic sanctions, and I was the first one to say, hey, this could really work and this could be a roadmap for how to do it. And it turned out this is the roadmap for how not to do it. You can't on the front door say, here are these sanctions, and then walk around the back door and basically open the door for them. These sanctions were so porous as to be like Swiss cheese. We focused on virtue signaling acts, confiscating a plane or a boat or a house, but we didn't focus on the structural things we needed to actually make the mandate that we believe to be just to come to life. And so Russia's completely worked around it. Their economy effectively is thriving. So what have
The ruble is higher than it has been in years.
we gained? It
Because
was the
there's
exact
restricted-
opposite of what we tried to do. Russia's current account surplus more than tripled in the first 4 months of the year. Prices
the
surged for its oil
crazy-
and gas imports, and imports plunged under the weight of sanctions. Well, if you're Putin and you're looking at this, you're like, wow, maybe I should be under sanctions more often. What country should I invade next? So not only did our sanctions package not work, and not only is the Treasury flailing around now trying to find even more backdoors, we actually opened a very dangerous precedent, which is now we allowed oil to settle in currencies that are not just the United States dollar. And now Russia and China are trading and settling in CNY. That's not good for us. This is not how you preserve the reserve currency of America. If you have a country that has existed in some way, shape, or form, the borders could be blurry, but roughly, for hundreds and hundreds of years, and in some cases thousands of years, where internally the population of that country views themselves, in a great way. They don't feel like
Nationalism.
their country is a meaningless nothing
Something that the West has forgotten.
country. Any attempt to economically humiliate such a country tends to have failed in the past and will continue to fail. And there tends to
Just think about it. Would you rather live in a country where everybody loves their country and will do anything to protect it? Or would you rather live in the country where everybody's trying to milk everyone out and no one really cares about the country?
be other countries who view it as one of these things where, well, if them, then why not us? And then they sort of, in a backhanded way, support everybody. So we end up in this odd situation where we are picking fights we cannot win. And the consequences for us are economically really damaging. And then the consequences for everybody else to stay on the sidelines is like economic prosperity. That doesn't make any sense.
So, which side do you take? The billionaire side of markets are going to continue going down for the foreseeable future? Or are you going to take the average person on YouTube telling you that markets have bottomed out? I'm going to place my bet on the billionaire, which is why I'm short. I have been short for some time. Let's have a look at TradingView again. So first downgrade is even further down. 5% down. That's SST, then ADNT, small rally but still down for the day. Our upgrades, MTD continuing to go higher and SCCO continuing to go higher. I think everyone overlooks analyst ratings, but they are a major determinant of stock prices intraday. I am going to end it there today. I hope you all have a wonderful rest of your day, and thanks for watching.